Welcome to The Explainer. Today, we're going to look over the shoulder of a top-tier institutional strategist. We've got our hands on a professional market analysis dated April 20, 2026, and we're going to break down exactly how the big money sees the forces shaping our global markets right now.
Okay, let's just start with the report's one-line summary, because honestly, it says it all. It perfectly captures this massive conflict driving everything. You've got this incredibly powerful anchor, company earnings, supercharged by AI, that's trying to hold the market steady. But at the same time, it's getting hit by these chaotic waves of geopolitical tension and inflation that just won't go away.
So here's how we're going to tackle this, exactly like a pro analyst would. We'll move through 5 key stages. We're going to start with the big 30,000-foot macro view, then drill down into the plumbing of the market, and we'll finish up with concrete strategies that you can actually wrap your head around. All right, first up, let's look at the widest possible lens. Right now, the entire economy is being defined by this fundamental tug-of-war between incredibly strong corporations and, well, increasingly stressed-out consumers.
And this slide just lays out that divide perfectly. I mean, look at this. On one hand, corporate earnings for the first quarter are just spectacular. S&P 500 profits are up over 13%, and that's being powered by a mind-blowing 45% growth in the tech sector. But, on the other hand, you look at the consumer. Delinquency rates are ticking up, especially for people with lower credit scores. It's the classic K-shaped economy, where the top is going one way and the bottom is going the other.
So this economic tension, it's completely shattered the market's hopes for what the Fed was going to do. The whole story has flipped like 180 degrees. A few months ago, everyone was talking about a summer of savings, expecting multiple rate cuts. Now, we're in a winter of waiting because inflation is just proving to be super sticky. If you look at the CME Fed Watch tool, the market has basically priced out all those cuts, especially with a guy like Kevin Warsh, a known hawk, about to have his confirmation hearing.
Okay, so now let's zoom in a bit and look at the market's engine room, the bonds and currency markets. This is really the foundation for everything, and the report is highlighting some critical warning signs here that we've got to pay attention to. The key number to watch here is that one in the middle, the 10-year real yield. The simplest way to think about this is it's the actual profit you make on a government bond after you account for inflation, and it's creeping up to 2%, which is a big deal. Why? Well, think about it. When you can get a guaranteed 2% return, risk-free from the government, those high-flying, risky tech stocks suddenly start to look a whole lot less attractive. It changes the math for everyone.
Now, to understand this next point, we need a quick definition. It's called the Fed's Reverse Repo Facility, or RRP. Just think of it as the financial system's giant emergency cash cushion. It's where big money market funds could park their extra cash, and it's been a huge shock absorber for the last couple of years.
And here's the punchline. That cushion is gone. I mean, look at that number. It has been drained from trillions of dollars, trillions, down to basically nothing. This is a massive structural shift in the market. The financial system's safety net has just been taken away.
Okay, so keeping that in mind, let's move to the stock market itself. Because the headline numbers you see on the news, the S&P 500, they are definitely not telling the whole story of what's been happening underneath the surface. I mean, on the surface, things looked absolutely incredible. The Nasdaq just finished a 13-day winning streak. That's its longest run in over 3 decades. It was a historic, headline-grabbing rally for sure. But the real question, the one a professional analyst always asks, is what was actually driving that rally? Was it healthy? Was everyone participating? Or was there something else going on? And when we look deeper, we see this fascinating split. While the big tech-heavy indexes actually fell a little bit today, the equal-weight S&P 500 and the Russell 2000, which tracks smaller companies, both went up. That's actually a great sign that risk appetite is spreading out. However, the report warns that the concentration risk is still extreme. The top 10 stocks alone are responsible for over 100% of all profit upgrades. And the mechanics of that historic rally? It was also being driven by something highly technical called a gamma squeeze. In simple terms, it's a feedback loop where a ton of activity in the options market forces dealers to buy up the actual stock, which creates this cycle that just pushes prices higher and higher. It's a classic case of the options market tail wagging the stock market dog. So, with this very complex and kind of contradictory picture, where are the big institutional players, the so-called smart money, actually putting their capital to work? Well, the flows tell a really clear story. Right now, it is all about geopolitics. Fears are escalating in the Strait of Hormuz, and that has pushed oil prices up to nearly $89 a barrel.
And this has created a really clear divergence. Energy, materials, and defense stocks are leading the way. And the ones getting hit, sectors that get hammered by high fuel costs, like airlines and consumer discretionary. But the bigger theme here, the major strategic shift, is fascinating. The report says institutions are moving away from just the AI software story and into what it calls the material layer. In other words, they're buying the real physical stuff you need to make the AI revolution actually happen. Power grids, copper, energy infrastructure, data centers. It's a huge move from code to concrete. And this brings us to the final and really the most important part of any institutional report, turning all this deep analysis into a concrete strategy with very clear scenarios and action plans. First off, it's pretty clear that Wall Street's top banks are deeply divided on what's coming next. You've got JP Morgan, who's super bullish, basically saying buy any 5% dip, and they're forecasting huge 19% earnings growth. Then on the other side, you've got Goldman Sachs being very cautious, pointing to that extreme concentration risk and predicting a more modest 12% growth.
So here's the game plan for the bulls. Scenario A. The triggers you'd need to see would be a de-escalation in the Middle East, oil falling back below $80, and of course, strong earnings from big tech. If the S&P 500 can break above that 7150 level, the strategy is to overweight industrial stocks and some specific semiconductor companies that are focused on AI edge devices.
And here's the bearish scenario. Scenario B. The trigger is an escalation, like a blockade of the Hormuz Strait that sends oil over $100 a barrel. You'd be watching for key thresholds like the 10-year yield breaking 4.4% and the VIX, the fear index, spiking above 20. The action plan here is all about defense. Use options to hedge, stay long physical assets like energy and copper, and short those really expensive software stocks. So, what's the final verdict? For right now, the report is neutral. It sees a market that just needs to take a breath and digest its massive gains. It's a classic tug-of-war between that powerful earnings engine and the severe drain on market liquidity. But looking a little further out, the view becomes cautiously bullish.
And we'll leave you with the report's black swan risk. You know, that low probability but incredibly high-impact event that the market is completely ignoring. What happens to the entire global financial system if the major oil-producing nations decide to stop selling their oil for US dollars, effectively breaking the petrodollar system that has been the bedrock of finance for decades? It's a huge question with profound implications.